What's up, founders, investors? Welcome back to Next Round Ready. I'm your host, Chris. Today we have special guest Daniel Ibri. And this is another investor I found on LinkedIn that I think you guys are going to learn a lot from. I like to see investors like this that are active, that are out there, that are connecting and sharing content information. So, Daniel, welcome to the show.
Thank you, Chris. It's a pleasure to be here. I'm happy to contribute.
So, I'll always like to start off with just your overall investment thesis. Like, what's the focus for you in the world of venture capital?
Cool. So nowadays I run a firm called Mindset Ventures, right? It's been almost 10 years since we started Mindset. I've personally been doing VC for almost 15 years now, so it's been a while. But in Mindset, we focus on a kind of a cross-border thesis on the B2B space. So we invest all the spectrum of B2B, mostly enterprise software. So always software based, always B2B focused. So no consumer, no hardware, no biotech, and very geographically limited for now. So we do only the US and Israel. So those are the two geographies we invest in. But our original roots are from Latin America. I'm Brazilian. I'm now at home, so calling from São Paulo, even though I stay the majority of my time in the US, we still raise the majority of our capital in Latin America, but only to invest outside in these regions that I mentioned, US and Israel. And if and when it makes sense, we help these startups expand to Latin America. So it's one of the values we try to bring to the table is to help foster international expansion for these companies. But in a nutshell,
Uh,
again, to your point, is like early stage, usually late seed to Series A, B2B software companies in the US and Israel.
okay. I love that concept. So, what are some of the early signals that you look for in a new startup? Since, if you said you're in early stage to, pre seed, that seed area, what are some of the things that you look for in those founders that you connect with?
So I think the most valuable point in decision making is always team, right? And people and founders. And not only, I'm not that concerned if they came from an Ivy League school or whatever education they had. Of course, that's important, but I'm more concerned about what they understand about the sector in which they are starting a company, how long they've worked there, what experience they have, what problems they faced, how did they come up with the idea of the startup they're building, why they decided to do this endeavor instead of just like looking for a job, or if they left a job, why decide to become entrepreneurs. So actually what motivates them is really, really important for me, and how they see the problem, how they see their industry, how much they know about it. So it's always people first in the decision making process, but also in terms of education of companies, as you asked, I think early traction is very important. And traction for me doesn't necessarily mean revenues, which are always great, but this can also mean number of users, number of pilots running, number of engaged companies you're working with, number of design partners, whatever. But I need to see someone engaging with your product, engaging with what you're building, extracting value out of it, willing to pay or to convert into a paid customer, et cetera, et cetera. So these early indications of traction are really important signs at early stage.
I've heard that before when it comes to the team aspect being the most important. And I'm curious, when you look at the team a founder has, is it a specific number of people, or is their education and background, their domain expertise something that you really analyze? Like, what goes into analyzing the team aspect?
So size is not that important at early stage. I see always number of founders. We like investing in companies that have two or three founders. Those are usually the best combination. We don't like solo founders. We believe, and statistics show that this is a very, very lonely journey, and it's hard for a person to take over everything and know about everything. So it's good to have someone to talk to, if to complement yourself. But also more than three or more than four, it becomes a little bit messy on the decision making. So two or three people, complementary skills, of course, high degrees of education, but especially experience in the marketing industry they are starting the company in. That's the most important part. How much they know about the industry, what connections they have, what insights they have to go to market, what competitive advantage they think about building, etc.
Okay. And so, with your investment thesis, your process, do you have personal experience that really shape you in terms of how you choose which companies to invest in? Because I know it's impossible for us to remove our personal biases. So I'm curious as to what yours are after 15 years doing this.
That's a very good question. I think what we try to do here at Mindset, and that's very different from doing things as an angel, right? Because if I'm an angel investor, it's my money, I can do whatever I want. And if I lose money, it's not,
Yeah.
it's my problem, right? But if I
Yeah.
lose investors' money, I need to, account for that and I'm reliable for that. And, I have lots of responsibilities, etc. So what we do at Mindset, we build a very, very, how can I say, complete investment process where we analyze dozens of, variables and things about each company that results in a very complete investment memo that goes to our investment committee that approve. There's a governance to approve the deals, which means we're trying the most to take the emotion out of the decision making. So make the decisions
Hmm.
as a team with the government, making sure we looked at everything. Of course, if I'm the one leading a deal or pushing a deal, of course I'm excited about it. I want to get it done, but I'm also giving the chance to my partners to read about it, get educated, have a discussion, hear from the founder as well, and maybe say, Daniel, this is cool, but no. Like I'm seeing this flaw, this flaw, this flaw. You're not seeing this point. This is too risky, blah blah blah. And I say, okay, fine. I respect your opinion. That's why we're a partnership. And then we don't make the deal. So we build this governance to try to take emotion out. But of course, like as an investor, there are things you like more, things you like less, sectors that you like more, sectors that are more excited about, and then you build around that.
Yeah, that makes sense because I always ask investors that question because I find that every investor has some kind of personal bias that leans into why they would invest in a company or not. And so, do you have a company that you invested in that you were like fighting tooth and nail for? I love hearing those kind of stories where like maybe everybody didn't agree, but you just knew you had to invest in this company because you really believed in the founder.
Yeah, there are a few. There's one recent example. I'm not going to mention which company, but there's one that we invested, I think it was end of last year, early this year. It was a company that actually fit in our thesis. So again, it had all the criteria. Otherwise, I would not be able to do it regardless, right? But it actually fitted the criteria. But when everybody heard the story and heard what it's all about, they say, yeah, I think it's too risky. They're taking too long to ramp. It's a very risky segment. It's long. It's in healthcare, so it's like long sales cycles. They should have more traction by now. I think they will have challenge raising money, etc., etc. But I just knew the potential of that thing was so great, and I really, really believed in the founder. And that's the thing when you go there, you see it, you look in the eye, and say, this guy's going to make this happen. You know, and I just hold the bet. I say, no, guys, I really want to do this. I really think we should. I really think I agree it's more risky, but on the other side, I think the reward is also disproportional. And I think I'd be really big, and I think we should really bet on this, right? And we ended up doing that. Again, it was not outside our scope, otherwise I wouldn't have done it, but it was not unanimous.
Ah, those are always good because it's fun to see how that plays out in the long run and really just to hear how teams work together. And what's your process like with your team that you work with when it comes to the due diligence and deciding who you want to invest in? Because as I interview and I connect with more investors, I'm finding that everybody's selection process is can be very different depending on how many people are part of the team and who's been there the longest. A lot of different things go into it. And I don't think founders really understand how in depth this process is.
Yeah, that's totally true. And even there's VCs that only make decisions by consensus. There's VCs where the partner has authority to do the deals he wants. There's no VCs that write a check very fast and don't do much diligence because they're afraid of losing the deal. There are others that do too much diligence. So it actually depends, firm by firm. In our case, what we do is like we have a kind of a funnel where, we look at the companies, analyze if they fit our scope or not, depending on the stage, industry they are at, geography, etc. And once we see it fits and it's interesting, we start deep diving. And after maybe two or three interactions where we really liked and we really think we should spend time there, we start doing our diligence. And the diligence is mostly led by our analyst team that is like actually doing the work and doing the research and writing the reports, etc. And also one of the partners that's leading the deal. So usually if it's like a US deal, I'm the one leading. If it's an Israeli deal, it's my Israeli partner. So we are the ones leading. There's a team with us working on that. And we start digging on the company. And we worked over the years in this investment memo that covers a lot of things from like, market, product, competition, differentiation, financials, background checks on the team, etc., etc. And we start filling this memo and filling the blanks as we go and as we start, uh, interviewing people, talking to the team, talking to customers, to other investors, looking at the documents, etc., etc. Right? Once we have this document ready and we build conviction, if we're after looking at all of this, we're still excited about the deal, we still think it's a good opportunity, then what we do is we share this document with our recommendation from the leading partner to the whole team, and bring this to the investment committee, right? And the investment committee is mostly our partners, and in every committee we bring the founder to pitch because we feel it's very important in our case that all the
Hmm.
partners meet the founder and have the chance to ask questions. So let's say you, Chris, is the founder of a company. I'm interacting with you a lot during this diligence process, but some of my partners never seen your face, right? They're just gonna read a code report. But I want them to, hey, look who Chris is, speak to Chris, ask Chris questions. Like you need to feel comfortable with Chris as well. So they're going to receive the report, they're going to read, they're going to prepare. But then at the committee meeting, the meeting always starts with the founder joining. They do a short pitch, like 15, 20 minutes. And then we have another 30, 40 minutes of Q&A, where other partners have the chance to ask questions directly to the founder. Then the founders drop, and we have another hour, hour and a half discussion on top of the call and the report if we should do the deal or not, and eventually we vote and decide to do it or not, and then close. So that's kind of the process.
Oh, that's a really, really good rhythm there. And so, how are you sourcing deals? What's your process to find these founders? Because when I talk to investors, usually it's just warm intros and that's it. Like, what's your process like?
Again, warm intros is important, right? If they come from other VCs they're leading, if the other VCs we invested with in the past, they're looking for co-investors. So this is also very important. We have a lot of inbound, as you can imagine. Like those are usually the biggest number of leads, but the less accurate ones because everybody wants your money. So, people from all over,
Yeah.
every type of idea, like thousands of ideas that, maybe 1% or half percent of them are useful, we should talk to. We also attend several events from, let's say, Accelerator. So let's say Y Combinator, 500 startups, Techstars, all these like accelerators, incubators of early stage start. They are feeding lots of opportunities to us all the time, which is also very important to see the flow, see what's happening. And one thing that we've been doing a lot recently meaning like the past maybe 2 years or in a half, is proactive generating leads. So mapping the thesis that we like or the segments we like to invest, mapping all the companies in that segment, and then chasing the companies and going after them. This is the hardest to do because you never know if they're actually raising at that time or not. Maybe you don't have a strong connection there, so you just have to cold email the founders or find someone on LinkedIn that you're personally connected. But those are usually the most interesting because it's a thesis you learn about, you research the market, you believe in that segment, you chose to speak to two or three companies, and then you just go after them. So we've been doing this a lot.
Ah, that's a new one. That's a really new process. Did you come up with that? That's really intricate.
No, I think some of the big VCs that want to lead deals in specific areas are doing that. So let's say if you are in one of the huge Silicon Valley VCs, you have a thesis around the usage of AI in finance, for instance, right? And you're a partner, you
Yeah.
come from the finance world, you believe in that, you do a lot of research, you map 300 companies doing that, you drill down to let's say five, and then you just go after the five and say, I want to meet the five, I want to choose the best and invest the best one. So there are funds doing that. Of course, if you're a very big fund or brand name fund, it's easier for you to get to these companies and they'll be more receptive, not necessarily for the smaller VCs, right? So we try to really add value to the founders from day one, try to be collaborative, etc. That's how we try to differentiate ourselves, not only on check size and stuff.
Yeah, I was going to ask you about that. That was my next question is like, what's your typical check size? I find that that kind of also ranks VCs in the minds of founders. Because when I talk to founders now, I talk to so many, it's like maybe 10 a week. And all of them are venture scale, all are raising. One of the first questions they have when I want to introduce them to a VC is check size. Like what vertical are they a part of? Like where are they focused? What's their thesis? Like they want details, and check size is definitely a part of that conversation.
Of course, yeah, we're trying to. So as I mentioned, as we grew fund sizes over the years, we're not leading rounds. That's important, right? So we're always co-investing. We really believe in partnering with other VCs. But check size usually between 1.5 and 2 million. when we invest for the first time, and then we sometimes double that or even a little bit more over time through follow-ons. So that's why we don't usually invest at early seed because 2 million for an early seed, if you're not leading, it's probably too big. So usually invest like late seed, Series A, sometimes early B, something like that.
Your process makes a lot of sense. See, this is why I love these interviews because in a quick 20 minutes, you can really understand a lot about the way VCs work. And one thing I love doing with the show is giving founders kind of a peek into the mind of VCs because so many founders I talk to don't understand the process of how VCs work. They just know they want money. They don't understand how you guys get paid and how you make money, how you have to make money for your investors. They don't even think about those kind of things. That's why this show is so important.
I totally agree, Chris. And if you allow me to do a comment like that, I also teach in a university here, and sometimes I'm teaching a VC course, etc. And I always say to these people, like, if you're an entrepreneur, if you're from outside the ecosystem and you look at a VC or you think about the stereotype of a VC, right? What you're gonna think? You're gonna think about like a very smart technology person in Sand Hill Road, sitting in a pile of cash, flying private jets and all that stuff. This is like the
Yeah.
stereotype. And I can assure like 99.9% of the VCs are not that. Like we are as much as entrepreneurs as any founders, right? Think about me. So I started my own VC firm. So I had to build a thesis, I had to build a team, I had to build a culture, I had to build processes, I had to raise money for myself, just like founders are raising for their companies. I need to raise for my funds. I need to deliver return. I need to grow over time.
Mm-hmm.
So it's the same challenges, just a different business, right? So we are also entrepreneurs, we're also learning, we're also growing, we're also raising. We also face the same challenges. We need to build teams, we need to scale, we need to deliver return. So it's very important to understand like how VCs work, what's the mind behind the check, how we are incentivized and all this stuff, how we make decisions. That's as important. And I always say to founders, like, they should diligence their investors as much as we diligence them, right? We want to partner with good
Good
founders.
point.
They should partner with good VCs. Like, they are marrying me for like, I don't know, 8, 10 years. Maybe I'm going to be on the board. I'm going to be bugging them every week. They need someone they trust, they know can add value. They want a long-term relationship. It's not just about money. Money is commodity. It's much more than that.
Yeah, that's one of my other questions I have for you is what value can you bring as an investor outside of just the money? Because I have a founder that I'm helping raise right now through the show, and he's like, "Look, I don't want to just work with somebody who's just going to throw money and then I won't talk to him for 6 months." A lot of these founders want somebody that can be hands-on, give them some kind of insight. So, what is that thing for you?
Yeah, we try to be very close to the founders, and we do several stuff. But I'd say the biggest one and the most important one, also for founders, is helping them on the sales strategy and opening doors. Because I mean, what every company needs at early stage to sell, right? Sell, grow, find customers. So we try to really open doors. This can be leveraged by this international connection we have and trying to do cross-border stuff and helping them in Latin America, if that makes sense, or we can just help them in the US or whatever market they want. But we really tackle our network to try to enable them to grow sales. And then we help them in like recruiting, marketing. Sometimes, we work as a kind of an advisor to the founder as well, more on the strategy side. We help them fundraise, we introduce them to other funds if they're raising a subsequent round. So there's a lot of things we try to do. But I think the most important part is like being very hands-on and having this personal connection with the founder.
Love that. So, before we go, what's one thing you wish every founder knew about raising capital?
Um, Only one thing. There's a few things, but I think the
The
most
most
important part
important.
is okay. The most important part, and the others maybe fall into that, is that raising capital is a process, right? Which means it's not just a thing like one time, hey, I'm gonna email this person and raise money. It's not like it's a process. You need to prepare, you need to organize, you need to have a CRM, you need to put a rhythm to the raising process. You need to map which investors are relevant, which investors invest in your thesis, who you want to talk to, how you're gonna get to these persons. Build the deck, build a data room, have all the materials they will ask about, be thoughtful about valuation and structure of the round. So all these things they need to come together. Sometimes I hear founders say, "Yeah, I want to raise money," and you ask like two questions, like what you're raising for, how much you're raising, what's your growth plan, and they said, "Yeah, I'll prepare that and send to you." terrible. You already burned the bridge, right? So you need to prepare.
Yeah.
Like there's a way to do that, right? And there's a preparation is very important. And go to market, talk to investors, wrap up, closing. So there's a way to do fundraising. Like it's very very technical. There's steps to it. To it. It's not like by feeling.
Oh man, that's a good answer. You can't just pop out one day like, "Hey, I'm raising now." Like you kind of have to have a plan and a process and be set up and prepared. Love that, man. Daniel, do you want founders reaching out to you? How can they connect?
Well, if they have companies that fit our thesis, so again, C to Series A, B2B software, US or Israel, please feel free to reach out. Add me on LinkedIn. I'm very responsive, as Chris saw. So feel free to reach out there. I'll be happy to connect with you guys.
All right, Daniel, thank you so much for being a great guest.
Sure, my pleasure, Chris.